Good evening, friends. On behalf of Pune branch, I welcome you all. I welcome today's faculty and regional council member, Yashwant Kasar sir. As we have selected this topic, this is again a very unique topic in GST law itself, because it is more depend on the notification and less on the provision. And I hope all your queries, most of your queries will get resolved in today's session, because the topic is very vast. We will try our best to cover the maximum litigative points in today's session. I request Yashwant sir to take charge of this session.
Good evening, everyone. First of all, I thank Pune branch of WRC and Chairman Rajesh Bhai for arranging this Gyansatra on GST, which will be covering various sectors and the GST provisions applicable to that particular sector. It will be really a knowledge enhancing series, and the issues will be deliberated in detail, because the speaker will be talking only on that particular sector intricacies and specific points related to that sector. So the today's topic allotted to me in this series is GST provisions related to real estate sector, which are the practical issues, what are the probable solutions, and specifically Rajesh Bhai stressed that I should cover the area related to joint ventures in real estate. So in my this 2-hour session, I would like to cover the practical aspects of it, and I request you to post your queries in the question answer section of this webinar, and we will take all the questions at the end. So during the session, I will go with the flow of my session, and I'm sure most of your queries will get resolved during the session only, and if any left, we will cover it at the end of the session. So with this, I will begin with my presentation. So I will be sharing my screen. Is the presentation visible to all of you? Rajesh Bhai? Okay, friends, when it comes to real estate and GST provisions, the complexities are involved when it comes to taxation and real estate. And so the complexities in GST law as well for real estate sector. Before GST, when service tax and VAT was applicable on real estate transaction, at that time also there were multiple views were there related to real estate transaction. And in GST era also, that still continues, although government is trying to bring simplification by way of reducing the rates, by way of disallowing the ITC and all those things. But still, the journey of GST provisions in real estate sector, still the simplification is required, more and more simplification is required. So to begin with, I will be dividing my presentation in these are the specific areas related to real estate sector provisions, typically works contracts, then government related construction contracts, then real estate projects under RERA, then TDR, FSI, long-term lease related issues, then sale of land and developed plots, and then renting and leasing of immovable property. These are the 6 broad areas where we can divide the real estate sector when it comes to GST provisions. In my today's session, I will be restricting myself to real estate sectors, real estate projects under RERA, then TDR, FSI, long-term lease related issues, and then sale of land and developed plots. So these 3 areas we will be covering in today's session. the areas like renting and leasing of immovable property, I will not be touching it, but still, since many times whenever we discuss this area, people try to give there are two arguments. Yes, of course, we know that a department is not, or the GST law doesn't allow us to take the input tax credit when we are giving that immovable property on rent or lease onwards. Although we have that Orissa High Court decision in case of safari retreats, that that High Court allowed the ITC, but still, since the department has gone to Supreme Court taking that issue, and it is the issue is pending with the Supreme Court. Still, as we know that the government stand when it comes to GST provisions, many times they amend the provision retrospectively. It is never it's not suggested that we can it's not suggested that we can rely on that High Court judgment. But still, if some client insists that we should rely on that judgment of Orissa High Court and claim the ITC of the worst contract services in case of renting and leasing of immovable property service, we should make aware the client about the gravity of that issue and the probable consequences. But as of now, the update is the issue is pending with the Supreme Court, and mostly the chances are that that the whatever happens, but that is not suggested while making the compliance. But still, if someone insists with the proper awareness to the client, we can do that. When it comes to real estate sector GST provisions, we can divide in this with these provisions. In the Act, these are the sections, then rules. These are the specific notifications related to real estate, and then FAQ circulars. So where the real estate provisions are covered in GST law. If we look at the GST law has only 174 sections. But if you look at the number of notifications, probably it has already crossed the 1,000 notification at least. So GST is a law of notifications and circulars rather than the GST sections only. And when it comes to real estate, if you read the law only or the act or the sections, you will never understand the real estate provisions. But to understand the real estate provisions in GST, we must look at the notifications. And in the notifications list, I have mentioned specifically this notification number 3/2019, 3, 4, 5, 6, 7, 8. This series of notifications of 2019, this broadly covers the current provisions related to real estate sector. When it comes to worst contract, before GST era, in service tax era, the definition of worst contract was different, and in GST period is different. The difference is now in GST, if that contract is worst contract, that must be related to immovable property. Earlier, even if the contract was related to movable property, that was you can call it as a worst contract in service tax era. But now in GST era, in order to qualify it as a worst contract, that contract must be related to immovable property, and some portion of property in goods must be transferred or must be involved in execution of that contract. Then only that contract of building, construction, fabrication, completion, erection, installation, fitting out, etc., will amount to works contract. That is the major difference. When it comes to transactions related to real estate sector, we must first see what is the definition of service in GST. And as all of us know, the definition is quite wide. Broadly saying, anything other than goods is covered under a definition of services in GST. So anything other than goods except so and so and so things. So that is the broadly definition, and technically it can cover any transaction in real estate sector unless specifically excluded. I always say in GST, for supply of goods or services or both, on each and every transaction, GST is applicable unless any specific exemption is there by way of notification or by way of schedules. So unless there is specific exemption is available in GST law, you can very well conclude that GST is applicable unless there is a specific exemption available. To just give an example, even if you go to mandir and buy some ladus or prasad over there, prasadam, GST is applicable on that also. But since it is specifically nil rated in GST notification, GST is not there. So even on the prasadam, GST is applicable, but still there is nil rated in the that is nil rated in notifications. Therefore, it's not GST is not applicable on that. So that is just an example, but each and every transaction GST is applicable unless specific exemption is there. So in GST, if you take an example of services, you know that in Schedule 2, if you agree with someone not to do anything, that is also deemed service. In GST for real estate transaction, I can give an example. Like if someone approaches one landlord and just execute Isar Pauti or Sathekhat with him, just give some token amount and MOU executed between them, and later on a new buyer approaches to that landlord and offers some higher consideration. In that case, if the previous buyer who has already extended some token amount and executed an MOU, if he accepts some compensation just not to execute his that arrangement and not to buy, means principally what service he is offering, that he is just agreeing not to proceed with the transaction. So not to do anything for someone is also a service in GST. So these kind of transactions, for this kind of transactions also, GST is applicable at the rate of residual rate, that is 18%. So technically on any real estate transaction, GST is applicable unless there is specific exemption. So what is specific? These transactions are specifically included in GST, which are listed in Schedule 2 of GST Act, and these transactions are specifically excluded, which are specifically listed in Schedule 3. So which are specifically included? So any lease, tenancy, easement, license to occupy land specifically included. So GST is applicable on that. Then any lease or letting out of building, including commercial, industrial, residential complex, etc., either wholly or partly, GST is applicable. If there is any specific exemption notification for any particular area, then that will only be excluded. Then renting of immovable property specifically included. Then construction of complex building, civil structure or part thereof, except where the entire consideration has received after issuance of completion certificate or after its first occupancy. So that is specifically included. And what is excluded? So in exclusions are covered in Schedule 3. The first exclusion is sale of land. So sale of land is outside GST. And then subject to para 5B of Schedule 2, sale of building. That is sale of building after completion. So sale of land after completion is land is outside GST, and sale of building after completion is outside GST, since it is specifically excluded by your entry in Schedule 3. As they have mentioned that sale of building after completion or after first occupation. So many times people confuse that what do the lawmakers mean by the first occupation. So they have clarified by way of FAQs that the first occupation of the project in accordance with the laws, rules, regulation of that state or central government or any other authority. So merely being if the building is under construction and someone occupies one of the apartment, makes a Vastu Shanti or Vastu Puja of that apartment and start living in there, that does not mean that apartment is occupied for this provision. But if you receive a formal occupancy certificate from the competent authority, then only you can say that you have the first occupation in your hand. And if you have occupancy certificate for particular units and that in that building, that is part occupancy certificate, then only for those units you can apply this provision. For other than those units, if occupancy certificate is not there, then those will not be treated as occupied, and those will be still under construction. Friends, as I mentioned earlier, that the journey of GST provisions for real estate sector is quite, I would say, quite complicated in GST era as well, because broadly it is divided in these two phases. That is the first phase of GST provision for real estate sector, which started from the implementation of GST, that is from 1st July 17 to 31st March 2019, and then from 1st April 2019 onwards. So initially, when the GST came, law came on 1st July 2017, the GST provisions were different. And from 1st April 2019, they have totally drastically changed those GST provisions, more particularly GST provisions applicable to real estate sector, specifically to the residential segment. And in between, I have just mentioned over here the date of 25th January 2018. That was the day when that notification was issued by the department, that is 4/2018, where the debate of development right and GST applicable on development, they have clarified by issuing that notification about the time of supply of the development rights. So they have just clarified by way of that notification that GST is applicable on development right for the first time formally, and then that discussion started, and they have formally issued that notification on that date. So we will see all those notifications as well. So as I stated, in the first phase, that is from 1st July 2017 to 31st March 2019, that is in first phase, the GST rate applicable on all the apartments was 12%, whether it is a residential apartment or whether it is a commercial apartment. So rate applicable was 12%, and ITC was allowed in that phase. So this 12% rate was effective rate. The notification rate was 18%, and after deducting the 1/3 deduction allowed for the land portion, the effective rate was 12%. And the effective rate for the affordable housing segment was 8%. The notification rate for the affordable housing project was 12%, and after 1/3 deduction, the rate applicable was 8%. Here, just to mention, in the first phase, the provisions were related to affordable housing project. In the second phase, they have came to the concept of affordable housing unit. So earlier, the project need to be affordable to qualify that concessional rate. But now in second phase, that is from 1st April 2019, they have given the definition of what is affordable residential unit. And even if a particular project is totally commercial, and in that totally commercial project, even if 1 or 2 apartments are there, residential apartments are there, and if they qualify that definition of affordable residential unit, then for those 1 or 2 apartments as well, also you can charge the concessional GST rate in the second phase. That is the main difference in the first phase and second phase. This is, as all of us know, that for the value of land, the GST provision allow a standard deduction of 1/3 only. They are not, they does not allow the actual land value from the consideration. So only 1/3 standard deduction is allowed, and even for leasehold land, that 1/3 deduction is allowed. So even if the project is constructed on leasehold land, the 1/3 deduction is allowed from the value for applying the GST rate. Then, as you know, the subcontractors, if the builder employs some subcontractors for constructing RCC work, tiling contractor, plumbing contractor, etc., then the rate applicable was 18%. And if the contractor is providing services for affordable housing projects, then the concessional rate was 12%. Then, since in the first phase, the rate was 12% or 8%, and the ITC was allowed. Since ITC was allowed, and all of us know that in GST, the basic concept is there: if you are affecting taxable supply, then ITC is allowed. And if you are affecting exempt supply, then ITC is not allowed. And if you are affecting taxable as well as exempt supply using common inputs, then proportionate ITC related to exempt supply, you need to reverse as per ITC reversal rule 42 and 43. So that is the basic provision in the GST. So reversal of in the first phase, since the ITC was allowed for all the project, residential as well as commercial, on the ITC reversal was required. But this reversal was required as per rule 42 and 43. These reversal provisions also they have changed these provisions related to real estate sector from 1st April 2019. We'll see what they have really changed and what was the reason of the change, because they have drastically changed those provisions. Just to give an example, earlier the same set of reversal rule was applicable for all the industries. Even if the registered person is a trader, even if he's a manufacturing unit or any industry, even if construction industry is there, manufacturing industry there, or any other industry, the same set of rule was applicable, reversal rule was applicable. And because of that, there was some loopholes of which because of that, this got manipulated by many of the developers, and that is the reason they have amended these provisions from 1st April 2019. Although from 1st April 2019 for the residential segment ITC is not allowed, but still for the commercial project ITC is allowed, and these provisions are applicable there. These are still significant, has relevance as of now also. So earlier the rule was, as you know, in case of exempt supply, ITC is not allowed, and in case of exempt as well as taxable supply, and you are using common inputs, then proportionate reversal is required. That reversal was required as per earlier rules periodically. That is, if you are filing monthly return or quarterly return, then as per periodicity of return you will reverse, and then at the end of the year. So reversal was required at the on yearly basis or periodically. That was the common rule applicable for all the industries. Typically, for any real estate project which has the lifespan of 4 or 5 years, let's say in the first year of the project commencement, only the RCC work is completed. So first year is the year in which the developer is only accumulating input tax credit. So first year is the year in which he is not effecting any kind of supply. But since his intention is to effect taxable supply out of it, he has just very well accumulated the ITC, and which is the eligible ITC, which he will carry forward to the second year. In the second year also, just some brickwork started, and he had just accumulated the input tax credit, which is he has properly availed in his books. Then in third year, he has effected some sales and sold some under construction units. So in the third year, he is effecting some taxable supply. So to effect that taxable supply, he used some input tax credit. So in third year also, ITC is allowed and no need of reversal of any input tax credit. And let's say in the fourth year, if in between the fourth year, he gets the completion certificate for his project, and he effects some supply or sells some unit after completion. So in this example, fourth year is the only year in which he is effecting taxable as well as exempt supply. So as per earlier rules, the reversal was required only in the fourth year, because in the first 3 years, when he is either effecting any supply, not effecting any supply, or let's say in third year he is effecting only taxable supply, there, since the inputs are not common inputs, there is no reversal required as per earlier rule. And the fourth year is the only year in which he is effecting taxable as well as exempt supply and using common inputs. So builders were reversing only the ITC related to fourth year in this given example. So the ultimate reversal was very less in the fourth year or fifth year when the project is nearing completion, and not much ITC is availed during that year. So because of that, the department has changed this rule from 1st April 2019. So what they have really changed now, from 1st April 2019, department is saying that no, for builders and developers, no more yearly reversal. For builders and developers, reversal will be required only at the end of the project, on completion of the project. And entire ITC, that is from the start of the project till the end of the project, will be considered as common ITC for builders and developers. So these two things they have changed. And the third thing is the reversal will not be on the basis of value, but it will be on the basis of carpet area. So on the basis of area, so that they have changed. So for builders and developers from 1st April 2019, now the new set of rule 42 and 43 is available. For others industries, the same earlier rule is still continuing. In earlier phase one, the builders and developers were not allowed any refund of input tax credit, although ITC was allowed, but refund of ITC was specifically restricted for builders and developers. That was not allowed. So that was the phase one provisions when the rate was 12 or 8% and ITC was allowed. Now in the second phase, they have brought some major changes. And there is also reason for the changes. When during that period, all these builder associations, CREDAI, etc., they approached the government to bring about some changes or some simplification in the provisions related to real estate sector. So they have made it somehow simple, and they have reduced the rates, and they have disallowed the input tax credit. So we will see what the changes they have made and what was the reason behind that. So firstly, they have changed the rates, and they have restricted the input tax credit. So now from 1st April 2019, they have restricted or disallowed the input tax credit for residential segment of real estate sector. Then if you go through the notifications from 3/2019 to 8/2019, you will find many definitions over there which are just copied and pasted from the RERA Act. So they have aligned those notification definitions with the RERA. That makes our job as a CA or the professional quite easy, that all the definition you can refer to the RERA. And for project also, they have defined that the project will be as per RERA. So all the residential and commercial apartments covered under RERA, all these revised GST structure will be applicable for them. This does not mean that even if the project is small and that is not registered under RERA, these rates will not be applicable for them. This is not the case, since all the units, all the projects, wherever RERA applies, that is registration under RERA is different thing. If your project qualifies a certain area criteria, some units in that project, that criteria, if you qualify, then registration is required. But that does not mean that the project is small or smaller than that registration requirement. Then also this revised GST structure is applicable to those smaller projects as well. So the definition of promoter is as per RERA only, and this revised structure is compulsory for all the projects from 1st April 2019, which have started from 1st April 2019. And for ongoing projects, at that time, they have given one option to offer the old rates. Those who have opted for that option, for at that time for those ongoing projects, they can charge the old rates for those ongoing projects only. But for the new projects, now it is compulsory that the new rates should be applied. So the new rates are 1% for affordable apartments and 5% for other than affordable apartments. And these rates are effective rates. If you go through the notification rates are 1.5% and 7.5%. So after reducing the value, 1/3 value for the value of land, you get these effective rates. And ITC is not allowed for these concessional rates. Then they have also defined what is RREP, that is residential real estate project. And this RREP definition you will not find in RERA, but only in these notifications. So RREP is a project in which the commercial portion is not more than 15%. If up to 15% commercial portion is there in that residential project, then you can call it as a RREP. And for such project, for those commercial apartment, you can still charge 5% rate without input tax credit. And for commercial projects, the rate is 12% with input tax credit. So for commercial project, even after 1/4/2019, there is no change in the rate and ITC is still allowed. So these are the rates, the new rates and the old rates. So 1%, 5% and 12% currently. Earlier it was 8% and 12%. So as I stated, the definitions, they have just taken it from the RERA. Then they have given the definition of affordable residential apartment over here. So now they have given two thresholds for affordable residential apartments. That is for metro cities, the area not exceeding 60 square meters. For non-metro cities, area not exceeding 90 square meter. And the amount threshold is 45 lakhs gross amount charge. That threshold is same for the metro as well as non-metro cities. So if that apartment is qualifying these two thresholds, that is threshold of area as well as the amount charged, then you can call it as an affordable residential apartment, and the concessional rate is then 1%. So as the ITC is not allowed now for the residential apartments, it must be paid off by using electronic cash ledger only. Then, although they have reduced the rates to 1% and 5% for the residential segment, but they have brought in some provisions like reverse charge if you are procuring from an unregistered person. So the provision says that the promoter, that is the developer, should procure all the capital goods for that project and at least 80% of inputs and input services from registered supplier. If not so procured, then tax is payable by promoters on the balance amount. That is the shortfall. All the cements must be purchased from registered supplier only. So for cement, there is no any threshold of or the criteria of 18%. For cement, the rate is 28%, and all the cement, that is 100% cement procurement, must be from registered person only. And all capital goods must be procured from the registered person only. So, and for other inputs and input services, at least 80% threshold must be met. So this is the provision they have brought in. So although the shortfall is on account of the short procurement of, let's say, bricks or the sand, etc., where the rate applicable is 5%, still, if there is shortfall in this criteria, the payment under reverse charge must be made at the rate of 18%. And this payment, this calculation you will make on yearly basis. So within that year, if there is shortfall for this kind of project, then, and one more thing, even if project is registered under RERA, whether not registered under RERA, even if builder is constructing on his own and he intends to sell all the units after completion, in that case also these provisions apply. So for all real estate projects, this provision of shortfall tax applies, and you must procure at least 80% inputs and input services from registered suppliers only. Then, as I stated earlier, the project means project as per RERA. So all of us know that project, whenever a developer intends to develop any project, he registers that project with the competent authority. And for competent authority, that may be a big project. And for RERA, you can divide that project in small project. That means in a single building, let's say the building is 10-floor building, you can divide that single building in 2 RERA projects. That is up to 5th floor, one RERA project, and from 6th to 10th floor, another RERA project. That is possible. Even if some project is there in which at the back side there is residential apartments, on the front side builder constructs some commercial shops and offices, and he can divide that projects in 2 RERA projects. Although for sanctioning authority that may be a single project, but for RERA purpose or for RERA Act registration with the RERA, that may be 2 separate projects. So that is possible. And for GST compliance, GST law compliance, we must look at the project means project as per RERA. So that we must keep in mind while complying with the GST provisions related to real estate projects. Then the rate for the subcontractors will be 18%, and for the if that is a residential project, and if at least 50% carpet area of that project is used for constructing affordable units, then the contractor can charge the concessional rate of 12%. And here one thing we must keep in mind: if later on that 50% threshold, that is if the 50% carpet area is not utilized for the constructing affordable units, then if there is any shortfall and because of that the concessional rate was not applicable on that project, then if there is any shortfall, then the payment should be made by the developer under reverse charge. If later on that has came out that that criteria has not met. So this is the provision in the notification. So as I stated earlier as well, that from 1st April 2019, they have amended the reversal provisions. So now, as I stated, entire project from the start of the project till the end of the project, entire ITC will be considered as common ITC. Reversal will be only at the end of the project, and reversal will be on the basis of area, that is carpet area, for revised ITC rules for builders and developers. And this will be applicable only for the commercial projects as of now, or if the project is a mixed project, then only commercial portion of that project. Because for residential segment or even for RREP, the concessional rate of 1 and 5% is applied and no ITC is aware. So no need of reversal for those projects. So this is that if any customer purchases under construction units from any builder and developer, and before getting the completion certificate, if he sells that apartments onward to any another buyer, then in my view, he's not required to pay GST on that. Since he's not effecting this transaction, that he's not selling that under construction unit to another buyer in the course of business. So in my view, no need of apply GST on that. If someone cancels booking with the developer, if someone books some apartments with the developer and later on if the agreement gets cancelled, and as a cancellation charges, if builder forfeits some amount, then on that amount of cancellation, that forfeited amount, GST is applicable at the rate of 18%, because it will be considered as tolerating an act or situation that is deemed service under GST. So here the rate of GST is 18%. As we have seen that GST provisions allow only 1/3 deduction for the value of land. Although this is not fair, because in many projects, the actual value of land, that is the portion in the amount charged for the value of land, is quite higher than 1/3. Still, since the notification says that only 1/3 value will be allowed, we have no other option but to charge GST on 2/3 amount. Still, litigation is possible. It is possible that someone can challenge it, but this is the call that client has to take. But still, looking at the government's intention or approach towards GST implementation, it will be a litigative issue. And although this can be legally challenged and not fair, still only 1/3 deduction for the value of land is allowed as of now. Then for any other charges like preferential location charges, external development, or charging for parking space, etc., the GST is applicable at the rate of 18%. And if before formation of the formal society of that project, if builder and developer is collecting maintenance charges from the flat buyers and they are maintaining that project, then GST at the rate of 18% will be levied on that maintenance service. For builder developer, this exemption of 7,500 per month is not available. That is available only for the housing societies, not for the builders and developers. Typically, those were the provisions related to rates, then the phases, the first phase and the second phase. Now, typically, any real estate projects in mostly in the parts of Maharashtra, Mumbai, Pune, because in the northern states or even in south, mostly the operating model is builder developers. They just buy the freehold land and they construct on their own. So these joint development arrangement provisions are not much applicable in those areas or that part of country. But typically in the Maharashtra state, most of the transactions happen on this joint development basis. So we will see what are the implications of GST provisions related to these joint development arrangements. So typically these are on two parts. That is at least that is either on area sharing arrangement or revenue sharing arrangement. And the third part is when the developer and landowner, they come together, they form an entity or SPV for that project, joint venture company, AOP, LLP, etc., and they carry out that project in that firm. So it will not make any difference. All the provisions we discussed till now will be applicable to that newly formed entity. But if there is arrangements like area sharing or revenue sharing is there, then all these provisions related to development rights, its valuations, the payment either on forward charge, reverse charge, the time of payment of that GST on development rights, then the construction service to the landowner, all these provisions come in picture. So as I stated earlier, the journey of GST, we have divided GST provisions related to real estate sector. We have divided in two phases. When it comes to real estate sector GST provisions related to joint development arrangements, we can bifurcate like this. JDA date, that is joint development agreement date. If it is revenue sharing arrangements, then the arrangement is quite simple. The landowner is transferring development rights in favor of the developer builder, and builder developer is just agreeing to share X percentage of revenue of that project with the landowner. So it's a one-way supply. That landowner is supplying development rights to the builder and developer. and builder and developer is just sharing the percentage of revenue with them. So that is the revenue sharing. When it comes to area sharing, there is a two-way supply. That is, landowner is supplying development rights in favor of the builder, and builder in turn supplying construction service to the landowner for some units. So this is a reciprocal supply. That is the area sharing arrangement. So if the JDA date is before 1/7/2017, that is before implementation of GST, then what will be the applicable provisions or the what will be the implication? So if the JDA date or the agreement of development rights, if that has been effected or the executed before 1/7/2017, then and even the construction is completed before 1/7/2017, then this transaction is not chargeable or not levied to GST. This is outside GST because the JDA date is also before GST and the construction is also completed before GST. But if the agreement is executed before GST implementation and some construction either partly or fully has been taken up, has been executed after 1/7/2017, that is after implementation of GST. In that case, for development rights, it is not subject to GST because at the time of that agreement, development agreement, typically the landowner transfers the development rights in favor of developers irrevocably. That is not revocable. So irrevocably, he has transferred the development rights in favor of the builder developer. So since the supply has been completed and he has transferred the development rights to the builder and developer before implementation of GST, in my view, it will not be subject to GST, development rights. But since the construction service provided by the builder developer to such a landowner is falling in the GST era, partly or fully, GST will be applicable on that portion. So the construction service will be chargeable to GST for that portion. Then if the JDA date is in the first phase of GST provisions for the real estate, that is from 1/7/2017 to 31st March 2019. In that case, development rights and construction service both chargeable to GST as per the old rates, that is the first phase rates, old scheme. And if the JDA date is from 1st April 2019 onwards, then both, that is development right as well as construction service, both are subject to GST as per the new rates. So this is broadly the classification and the treatment will be given accordingly. So we have seen this timeline, and here, as I stated earlier, I have mentioned that date 25th January 2018. This is the date on which this notification is issued by the department, which has stated the time of supply for the development rights and for the construction service in case of area sharing arrangement. So what is the argument by the department? Because before issuance of this notification, there were two views among the professionals, among the sector as well, among the real estate sector as well, whether GST is applicable on development right or not, whether it is applicable on TDR or not. There were two views. And typical argument of the assessees or the professionals was that GST was not applicable on development, the service tax was not applicable in service on the TDR and development right, etc. at that time before GST, because many apex court decisions or the judgments were there. We stated that TDR or the development rights are nothing but rights arising out of land, which is also part of immovable property, and service tax was not applicable on that because of that. But when GST came, the lawmakers very specifically drafted these provisions, and now the argument is that in GST law, at the end they have given the Schedule 3, and which they have listed the transactions which will not be regarded as supply, And in that list of Schedule 3, they have specifically mentioned sale of land and sale of building after completion. So they have excluded sale of land, they have excluded building after completion, but they have not mentioned immovable property over there. They have not excluded immovable property. And if you look for the definition of immovable property, you will not find it in the GST Act. That is not given in the GST Act, but you can look for it in the General Clauses Act or Transfer of Property Act. And the definition of immovable property includes sale of land, sale of building after completion, and sale of rights arising out of land. So although rights arising out of land is a part of immovable property, since it is not specifically excluded by way of Schedule 3, GST is applicable on that. So they are treating it as a deemed service under GST, and GST is levied on that. And because of this argument, department is levying GST on the development rights and TDR as well. So in the first phase, as I stated, in the first phase, that is from 1/7/2017 to 31st March 2019, the GST was applicable on development rights on forward charge basis. Forward charge basis. And in the second phase, it is still applicable, but under reverse charge basis. And what was the reason? In the first phase, it was on forward charge basis. That means if there is an area sharing arrangement and landowner is transferring development right to the developer, then he is required to take the GST registration. He was required to charge GST. He was required to make an invoice in the name of developer and charge GST in that invoice at the rate of 18% for development rights. And typically for big projects, if there are 10 landowners, 50 landowners and a single developers, then 50 landowners were required to take the GST registration, then charge to GST on development right to the developer. Then developer was allowed to take the input tax credit of that GST. So in a way, this provision or this GST charge was revenue neutral because the developer was allowed the ITC of it. So ultimately, the provision was revenue neutral, but since it was on forward charge basis, they were required to take the registration and charge and GST. This was hardship for a real estate project. So when these builder associations, they approached the government, they have made this change. And now from 1st April 2019 onwards, now for development rights, for TDR, for FSI, for additional FSI, for premium FSI, whatever is the form of that development rights, if promoter is procuring that, I am specifically using the word promoter. If promoter is procuring that, if the promoter is the receiver, then it is under reverse charge. If anyone other than promoter is procuring that, then it is still under forward charge. For example, if some trader in TDR, he is procuring TDR from someone else and he is procuring that for selling onwards, then he is not the promoter. In that case, still today the forward charge applies. So if you are selling TDR to someone, it is suggested that take the undertaking from that person for whether he is promoter or not, whether he is utilizing that TDR for his project or not, and take the undertaking from that person. Otherwise, if later on it is found out that you have sold that TDR to a person who is trader in TDR, then it was your responsibility to charge on forward charge basis. So that is suggested that undertaking must be taken if you are selling that TDR. So those are typically the provisions from 1st April 2019 onwards. So from 1st April 2019, the reverse charge is applicable on development rights, FSI, TDR, etc. And if the promoter is utilizing that TDR, that FSI, development rights, additional FSI, whatever it is, form of development rights, then the provision grant him a conditional exemption with the condition that if the promoter sells all the units of that project before completion certificate, before completion, then he is not required to pay under reverse charge. Then there is exemption. But if some units remain unsold as on the date of completion of that residential unit, residential project, then to the extent of that unsold area, this exemption will be withdrawn and the developer is required to pay GST under reverse charge for that portion. So for all the projects, commercial as well as residential, reverse charge is applicable from 1st April 2019 onwards. So for all the projects under RERA, the reverse charge is applicable. But for the residential segment, there is conditional exemption. For commercial projects, there is no exemption available. For commercial projects, the developer is required to pay under reverse charge at the rate of 18%, and he can take the ITC of it while applying the 12% rate onward to his independent buyers. So that is the provision. For residential project, there is a conditional exemption that if he sells all the units before completion, then the exemption is there, and the exemption will be withdrawn for the units remain unsold as on the date of completion. So in the notification 3/2019, they have given the formula for calculating the exemption amount, etc. And that quite simple. You just have to calculate the proportionate ITC. So whether my voice is proper, whether the volume is very low. Some people have just in the chat box, I'm okay. Is it correct now?
Yeah, okay.
Okay, sir. Okay. So as I stated earlier, there is a conditional exemption available for the residential segment of real estate sector. And if some units remain unsold as on the date of completion, then you need to pay under reverse charge for those units. And there also they have kept the upper limit, upper cap. That upper cap is 1% of 5% of the value of the unsold units. So that value must calculate, and on that, that is the maximum amount you will pay if some units remain unsold as on the date of completion sum for the residential apartments, residential projects. And for calculating that value of apartments remain unbooked as on the date or unsold as on the date of completion, the rate, base rate will be the rate with the charge with the independent buyer nearest to the date of completion. Time when the liability of promoter arises. So this they have changed from 2nd June 2021. Earlier, the provision was on the date of completion of the project or at the time of occupancy certificate, whichever is earlier. But typically, if there is a area sharing arrangement, and if some units are allotted to the landowner, and if landowner wants to sell some portion of his area before completion certificate, then the notification allows him to take the input tax credit of the GST charged by the promoter to him. So let's say if that project is of 100 flats, 40 units are allotted to the landowner and 60 units are available for sale to the for the promoter. And out of those 40 units allotted to the landowner, if he's selling 30 units before completion, then he must take the GST registration for himself and he must charge GST to his buyers for those units which he is selling under construction. And for those units, for the construction service provided to him, the developer will charge him at the rate of 5% or 1%. This GST charged by him, by the developer to him, the ITC is allowed to the landowner. But to allow him, to enable him to take the ITC of this amount charged by the developer, they have changed these provisions that he can, the time limit when the promoter can charge in any tax period not later than the tax period in which the date of issuance of completion certificate or the occupancy certificate. So you can prepone that. It's not required that at the time of completion only you can charge. You can prepone that point of taxation, and before completion you can charge the developer landowner, so that landowner can take the input tax credit of it and utilize that ITC. So in any tax period, but not later than tax period in which the completion certificate is received. So this is the time when the GST charge to the landowner's portion, and same time limit, time period or the time period is defined for the amount to be payable by the promoter under reverse charge also. So to enable, in case of commercial projects, to enable the promoter to take the to take the input tax credit, the time limit is any tax period before the completion certificate. Then what will be the value of supply of service of development rights or FSI by the landowner to the promoter? So typically in the area sharing arrangements, two supplies, simultaneous supplies are affecting. One supply from landowner to the developer, that is supply of development rights, and another supply is of the construction service, that is construction of superstructure from the developer to the landowner. So this is the barter transaction, I would say, and the value will be exactly same for these transactions. So the value defined in the notification will be deemed as the value of similar apartments charged by the promoters from the independent buyers nearest to the date on which such development rights or FSI is transferred. So nearest to the JDA agreement, the first transaction after JDA, that will be the base value for calculating this value of development right as well as construction service. So for both of these values, the base will be the value of the similar apartments with the independent buyer which you have sold nearest to the development arrangement. Because of this, many developers they try to execute the first agreement after the development first agreement with the independent buyer at the rate of ready reckoner. So that is the mostly many builders are following, so that this value can be kept minimum. So that will be the valuation of this development rights or the apartments which are allotted to the or the construction service provided to the landowner. So although in the notification this value is defined, this is applicable from 1st April 2019. Before 1st April 2019, these notifications were not there. And this valuation was not defined anywhere in the Act as well or the rules as well. So what we were doing, many professionals were doing, they were following the valuation rules. And in GST, the valuation rules are Rule 27 to 31. And by applying that valuation rules, the argument was that value of similar apartments is not comparable because you cannot that landowner and the independent buyer are not at the same footing. Both have different, I would say, you cannot treat them similar with the similar treatment because landowner, he already owns the land and you are just supplying him the construction service, that is construction of superstructure. Whereas for independent buyer, you are supplying him construction service as well as some portion of land. So this is the basic difference. So the landowners, since he's owning the land already, you cannot keep both of them at the same footing. So we were not using the rule of similar apartments, and we were using the rule of cost plus 10%, that is rule 30. And so the construction cost for that construction service plus 10% reasonable profit. So the 110% of the construction cost, that was the valuation adopted before 1/4/2019 in most of the cases. And that was the argument of the professional. And if you ask me, that was a valid argument. And we charge GST on that valuation at the rate of 18%. That is construction cost plus 10% and then 18% on that. But from 1st April 2019, since from that date, department has specifically notified the valuation in the notification itself, that value will be of the similar apartments with the independent buyers nearest to the date of development agreement, and that should be the base value. Since they have notified this valuation in the notification itself, we have no other option but to adopt this value. Although because of this, GST is payable on much higher amount, although this is beyond the section 15, that is valuation of the CGST Act, the valuation section, still we have not much option but to adopt this value. But for value of development rights, you should deduct the 1/3 from that value as given in paragraph 2 of notification 11/2017, and after that deduction of 1/3 on 2/3 value, you should charge at the rate of 18%. So as I stated, although we were going with these valuation rules, as of now, that is not possible, since from 1st April 2019, they have issued the valuation, what will be the valuation in the notification itself. So if, as I stated earlier, if landowner is himself selling some apartments of his portion before completion, then ITC is allowed to him of the GST charged by the landowner promoter. And only for that GST, ITC is allowed. For any other service, even for landowner, ITC is not allowed. Friends, these were the provisions related to joint development arrangements and area sharing. We'll be seeing some examples also, some case studies as well. But for housing society redevelopment, these provisions will be applicable as it is. Only thing is in place of landowner, there will be a housing society. And the housing society, along with its member, they will engage with some developer for the area sharing arrangements, and the builder developer will allot the existing members the flats or the units with some additional area, with some additional consideration, sometimes with some rent or the compensatory rent for some period of the development. He will compensate that rent or some additional amount as well, or some contribution towards the corpus fund of the society, whatever will be the maybe the consideration. So this kind of typical arrangement will be there, and this is a typical area sharing arrangement. In that case, in such kind of arrangements, when the society along with its members is supplying development rights to the developer, that is one supply. And another supply is when the developer is supplying construction service to the society members. So whatever construction service is provided to the society members along with the society, on that entire area, GST is applicable. It's not that if the earlier flat was 1000 square feet and now the area allotted is 1300 square feet, then the GST is applicable on entire 1300 area, which the developer is constructing. And not only the further, that is additional area. GST will be applicable on the entire area because the earlier old structure will be demolished and the new superstructure will be constructed. So on the entire area, whether for additional consideration or whether free of cost, on whatever terms the developer is providing to the society members, on that entire area, GST will be applicable. Correct. So the valuation, what will be the value? As we have seen, you will look for the base value of the first transaction with the independent buyer nearest to the development agreement. That will be the base for the rate. And taking that base, you will value, work out the value of this area allotted to the society members. And on that value, GST will be charged at the rate of 5% or 1%. So that is one thing. That is value of the construction service provided to the society members by the developer. And what will be the value of development rights? So the value of development right will be value of this construction service provided plus any compensation, any monetary compensation provided, any rent reimbursement provided, whatever form of compensation, monetary terms provided, you should add to it, and that will be the value of the development rights in such kind of arrangements. Typically in Maharashtra, now some societies, they intend or they choose this method of self-redevelopment as some additional incentive is allowed by the Maharashtra government for self-redevelopment of societies. Some additional FSI is permitted, some concessions in the rate of additional FSI, that challan amount, some concessions are provided, or a single clearance window, etc., etc. Some concessions are extended for the self-redevelopment of societies. So what will be the GST provisions applicable for self-redevelopment? So to understand this, when we say self-redevelopment, that means there is no, the arrangement is like that the society is redeveloping its plot on its own. They're engaging some contractor, some work contractor, just giving work contract to them for constructing the structure, superstructure of that society land. And that is the only limited arrangement with that work contractor. If earlier there are 50 units in that society, and after self-redevelopment, if society is constructing, let's say 70 units, then those additional 20 units which the society is constructing, society will sell those additional 70 units to the outside buyers. So on its own, society is developing that project by employing the work contractors. So the treatment will be simple, that for those additional units, additional 20 units to the independent buyers, society will charge 5% or 1%, whatever the applicable rate is there. That will be the treatment. For the society member, and they will charge, if a society is selling under construction, it will charge 1% or 5% to the independent buyers. And society will, of course, will not be taking any input tax credit, since those will be the residential units and concessional rate is they are charging. Society need to follow that rule of 80% procurement from the registered supplier. So GST provisions, as it will be applicable to any promoter developer, will be applicable to society as well, because it will be the promoter developer in this case, and they are very well covered in the definition of person under the GST. So society need to get the GST registration, and all these provisions will applicable to the society as it is. But only debatable point here is what will be the case of GST on flats retained or allotted to its existing members. Whether society should charge GST on the flats retained by the existing members or allotted to the existing members. What will be the case of that? So friends, we know under GST, what is the case of the mutuality with the GST law? Under GST law, there is no any concession for the concept of charity or the concept of mutuality unless specific exemption is there. So unless there is specific exemption, even for charitable work, GST is applicable. And there is not any concession for mutuality concept as well. So although there is a decision of Honorable Supreme Court in case of Calcutta Club Limited, which upheld the concept of doctrine of mutuality, but the GST lawmakers, they have amended the section 7, that is the scope of supply under GST, to overcome that decision given by the Kolkata, in case of Kolkata Club Limited, by the Honorable Apex Court. And now, in the section 7, they have introduced a new clause, AA, with the retrospective effect. So, although, and as per that clause, the activities or transactions by a person other than an individual to its members or constituents, or vice versa, for cash or for deferred payment or for other valuable consideration. They have given explanation as well. That is, for the purpose of this clause, it is hereby clarified that notwithstanding anything contained in any other law for the time being in force, or any judgment, decree, or order of any court, tribunal, or authority, the person or its members or constituents shall be deemed to be two separate persons, and the supply of activities or transaction inter se shall be deemed to be taken place from one such person to another. And they have inserted this clause retrospectively with effect from 1st July 2017. So to overcome the decision in case of Kolkata Club Limited by Honorable Supreme Court, they have amended the law retrospectively. So this is the approach of governments towards GST provisions. And since they have amended or inserted this clause retrospectively, this society and its members, you cannot say there is a concept of mutuality and they should not charge GST in case of self-redevelopment to its members. Although debate is possible, some professionals still debate on this issue. In my view, as per the scope of supply that inserted new clause, these two are separate persons, also as per the definition of person. So GST should be charged on the flats retained or allotted to its existing members by the society in case of self-redevelopment. And that will be at the rate of 1% or 5%. And since this is a litigative issue, if you don't charge in later on, after 2-3 years, 4 years, many times society members, they keep on changing. It's always suggested that you can suggest the society members to charge GST on that, because if later on that is charged, the interest and penalty implication may be there. So this is my view in this society redevelopment case. Then the concept of mutuality we have seen, and then in case of slum rehabilitation project, what is the scenario? Typically in SRA projects, the land belongs to government, or sometimes private owners are also there, but government intervenes and gives some concessions for those SRA projects. Typically in these kind of projects, the developer constructs that projects, allots some units to the slum dwellers. Although slum dwellers are not the landowners, some units are allotted to them. And in turn, the developers get some additional FSI, TDR, etc. If landowner is there, he allots some units to landowner as well. So although the units allotted to the slum dwellers are free of cost, although slum dwellers are not in turn supplying any consideration or the transferring or providing any consideration to the developer, still the consideration will be provided by the government or the landowner by way of development right. Although the consideration is flowing from some third person, third party, still it will be qualified as supply under GST, and GST will be charged on the units supplied to the slum dwellers free of cost. All other treatments will be same as we discussed earlier. So on that entire construction service provided to the landowners, slum dwellers, GST will be charged in this scenario. And if that real estate project, residential real estate project, if some units remain unsold as on the date of completion, the developer need to pay under reverse charge. All those provisions will be similarly applicable in this SRA projects as well. Then, as I stated earlier, in GST, tolerating an act or situation is also a deemed service. That is the reason for cancellation charges. If developer is charging something, it is subject to GST. For any penalty for breach of contract or for future of deposit, advance or advance as penalty, etc., then GST will be charged on the all these kind of charges. Then cancellation of apartment. What will be the treatment? This is many times happens that if someone books a flat with a developer and for some reason or other he cancels that booking. If he at the time of booking, if he pays some token amount, let's say 10 lakh rupees as a booking amount, and later on he cancels the apartment, but at the time of booking, if he tenders the advance of 10 lakh, then the developer pays GST on that advance amount at the rate of, let's say, 5%. 50,000 rupees is paid to the government, and later on that booking gets cancelled. So what will be the treatment? So if within the same financial year the booking is cancelled, or within 6 months, or let's say now after the revised provisions up to the month of October, if the developer is most of the cases filing monthly return, then up to the October month, that is the filing of return is before the 30th of November of the next year. If up to the October of the next month, if that booking is cancelled, then the developer can give the treatment by way of adjust that treatment in his GST returns by way of issuing a credit note. That is possible. So he can very well in this case refund the GST amount as well to the customer who is cancelling that booking. That is possible, and he can adjust that amount by way of credit note, issuing the credit note. That is possible. But what will happen if the amount, the booking is cancelled after that cutoff date of the November? So in that scenario, the issuance of credit note will not be possible, and he cannot adjust in his return. In that scenario, the only option available is claiming refund. So it was found out by the department that many times builders are applying for the refund in such scenarios, and they are not passing on the benefit of that refund amount to the actual beneficiary, that is the customer who is cancelling that apartment. So to enable this refund to this customer, now recently they have just amended this provision, and now they have prescribed the manner for filing of application of refund by unregistered person as well. So the unregistered person, by utilizing this facility given, they can apply for the refund within the period of 2 years from the relevant date, and the relevant date is defined as date of issuance of letter of cancellation or contract, that the date of cancellation agreement or the letter of issue of cancellation contract, this will be the relevant date. And from that date, within a period of 2 years, these unregistered buyers, they themselves can claim the refund of GST on paid on this booking amount. This will be used if the mechanism of credit note is not possible. If the refund, if the booking is cancelled after that cutoff date of November of the next year. So that these were the provisions applicable for the refund of in case of cancellation of bookings. So friends, till now we have seen what are the provisions applicable in case of real estate, residential and commercial projects. Then what are the applicable provisions for joint venture arrangements as well. So now we will see by way of case studies what will be the treatment for various area sharing as well as revenue sharing arrangements. So this is the case one, that is pre-GST period and old scheme, that is and it is of real estate, residential real estate project, and the arrangement is area sharing. If the date of JDA is 15th April 2016, that is JDA is entered before implementation of GST, and the construction started after implementation of GST, that is on 1/9/2017, and construction completed on 30th June 2018. That is construction is services providing the first phase of GST. So the total apartment were 90, landowner share is 40 apartments and developer shares is 50. Out of those 50 apartments, 20 apartments are sold before completion and 30 apartments are sold by the developer after completion. So for those 30 apartments which are sold by the developer after completion certificate, those are not taxable under GST as per Schedule 3. But for those 20 apartments which are sold before completion, GST is applicable. And the development rights here are not subject to GST since the JDA date is before GST implementation, as I stated earlier. So this is the case one. Then the case two. In this case, the JDA date is 1/10/2017, that is after implementation of GST and the first phase. Then the construction started and completed in the first phase only. Total apartments 100. Landowners share or the consideration for development right is 40 apartments out of 100 and 2 crores monetary consideration. And the developer's share is 60 apartments. Okay, so here the development rights are chargeable to GST, yes, and since the development agreement is executed in the first phase of GST implementation for the real estate sector, it is charged on forward charge basis by the landowner. So in this case, landowner was required to get itself registered under GST and charge GST to the developer, and developer was allowed the input tax credit of it. And the construction service provided to the landowner by the developer, yes, it is chargeable to GST. And what will be the value? So the value of apartments to the landowner, apartments allotted to the landowner by the developer, the value of similar apartments or value of valuation as per valuation rules 27 to 31. So there were two views relevant at that time. Some professionals were adopting the value of similar apartments as taking the base that in service tax period also that valuation was defined by way of department note or the clarification. So some were adopting that value of similar apartments and some professionals were adopting the value as per valuation rule, as I stated earlier, that is cost plus 10% method. The value of development rights will be, in this case, value of apartments allotted to the landowner plus monetary consideration of 2 crore rupees. So, and what will be the time of supply of apartments allotted and what will be the time of supply of development rights? Both will be same, and it will be the date of allotment of possession of apartments to the landowner as per the notification number 4/2018. So the time of supply will be the date of allotment of possession, and the rate of GST for construction of complex service here. In this case, since this was the first phase, rate was 12% with input tax credit, and the rate of GST on development right was 18%. Then the case 3, that is old as well as new scheme and residential project and area sharing arrangement. Here, the JDA date falls in the first phase, and the construction is started and completed in the second phase. So here there are 120 apartments in the project. 50 apartments are landowner's share plus 1 crore monetary consideration plus 18 months rent reimbursement. And the developer is retaining 70 apartments for his share to sell to his customers. So here development rights are chargeable to GST, and since the JDA date is falling in the first phase, the forward charge is applicable. On forward charge basis, landowner should charge to the developer. But here is a catch. Here, since the construction service is provided in the second phase, that is after 1/4/2019, where the new set of rule is applicable, that is concessional rate of 1% and 5% is applicable. In this case, since the ITC is not allowed to the landowner, here the ITC is not allowed to the landowner, there will be the loss of ITC, of the GST charged by the landowner here. In some cases, landowner has already issued that invoice here and charged that GST at the rate of 18% to the developer. But since the developer is executing the construction service in the second phase, he's charging at the rate of 1 or 5%, and he is not in position to take the ITC. So that is getting lapsed. In some cases, landowner has not charged GST at all. They have just not complied with that provision. So as of now, what is the option available in this case, in this scenario? So if you see, strictly speaking, as per the provision, he should charge as per forward charge basis to the landowner. Okay, and landowner will not be in position to take the input tax credit of it. Correct. But if he has not complied with the provision, and if you ask my personal view, in that case, we can suggest the landowner or the developer rather, that although development rights are supplied to you before in the first phase, that is before 1/4/2019, if some units are unsold, units are there in that project, you should comply with the provision of payment under reverse charge for the development rights for those unsold units. By that way, you will end up paying GST on all the units in that project. That is, for under construction units which you are selling, you are charging to the independent buyers. For the apartments you are allotting to the landowner, you are collecting and paying on that. For the units remain unsold, you are complying with that reverse charge provision. So department's view can be liberal in that situation, that the entire value of that project GST is recovered by some provision or other. So the department officer may take liberal view and grant you that concession. But again, that will depend on officer to officer. But that liberal view can be taken, since this is the case where ITC will be charged on forward charge basis, but ITC is not allowed. So that scenario is possible, or that stand can be taken in my view, although different view is possible, but that is my personal view. Here in this case, the value apartments allotted to the landowner will be as per the notification, that is the value charged for similar apartments in the projects from the independent buyers nearest to the date of JDA, and value of development rights, since this is falling in the first phase, value of allotment of apartment allotted to the landowner plus 1 crore monetary consideration plus 18 months rent reimbursement. And the time of supply of the apartments allotted is any time before or on the date of issuance of occupancy / completion certificate. Rate of GST for construction of complex service is 1 or 5% without ITC. Rate of GST for development right is 18%. Then the case 4, new scheme, residential project and area sharing arrangement. Here, the date of JDA is also in the second phase, and the construction service is also provided in the second phase. It is a residential project, 150 units, 60 units are provided to the landowner along with 3 crores monetary consideration and 24 months rent reimbursement. And 90 units are kept by the developer for selling in the open market. So here, development rights are chargeable to GST, yes, but those are chargeable to GST on reverse charge basis. And since this is the project of residential apartments, a conditional exemption is also available as the project is of residential units to the developer. Here, the value of apartments allotted to the landowner will be the amount charged for similar apartments in the project from the independent buyer nearest to the date of JDA. That is the value defined in that notification 3/2019. Then value of development rights will be the value of apartment allotted to the landowner plus 3 crores monetary consideration plus 24 months rent reimbursement. Also, if the developer is making payment for some premium FSI from TDR, which is procuring either from development authority or from open market, whatever charges he is paying towards development rights, premium FSI, additional FSI, ancillary FSI, TDR, etc., that all value you should add to the value of development rights for doing that calculation of payment under reverse charge at the time of completion with respect to unsold units. So you should take into consideration all these payments towards different forms of development rights. Then time of supply of apartments allotted to the landowner and time of supply of development rights will be same, that is anytime before or on the date of issuance of occupancy or completion certificate. Then rate of GST for construction or complex service will be 1 or 5% without input tax credit. And rate of GST for development rights 18%, but the tax shall not exceed 1 or 5% of the value of apartments remain unbooked or unsold on the date of issuance of completion or occupancy certificate. Then the case 5, date of, here it's a new scheme, it's a commercial project now, area sharing arrangement is there, and the date of JDA is 1/10/2020, that is in the second phase, and construction also in the second phase. So it is totally commercial project. 100 commercial units are there, shops and offices. Landowner is provided with 40 commercial units plus 2 crore monetary consideration. Developer share is 60 commercial units. In this case, development rights is chargeable to GST on reverse charge basis by developer. Here, exemption is not available. He should pay under reverse charge, but no exemption. He should pay under reverse charge and claim the input tax credit. So, in this case, the value of commercial units allotted to the landowner will be the amount charged for similar commercial units. If offices are there, then similar office of the similar category. If shops are there, then the similar shop category shops. So amount charged for the similar commercial units in the project from independent buyer nearest to the date of JDA. And value of development rights will be value of apartments allotted to the landowner plus other considerations, that is 2 crores monetary consideration plus if he is procuring from the open market or from the development authority any TDR, FSI, etc. And the time of supply will be similar, that is at any time on or before the date of issuance of completion or occupancy certificate. Then the rate of GST for construction of a complex service will be 12% with input tax credit, and the rate of GST for development rights will be 18%. And since this project is a commercial project where input tax credit is allowed, on the date of completion, no need to pay under reverse charge for unsold units, but you need to reverse the ITC related to the unsold area as on the completion date. You will claim the ITC. So the ITC related to exempt supply, you need to reverse, which you are selling, the units which you are selling after completion date. So to that extent, the ITC must be reversed as per the amended rule 42 and 43. So that reversal will be there. In many cases, if you work out, in some of the project, it is found out that the ITC, since the developer is paying under reverse charge at the rate of 18% and claiming the ITC, and then also construction service he is paying averagely at the rate of 15 or 18%, and that ITC is also with them, and he's selling his share at the rate of 12%, and also he charging to the landowner at the rate of 12% for his share in the commercial apartments. So many times this ITC is not consumed totally and it adds to the cost of that project. So this calculation you must make beforehand, before starting that project, and accordingly the developer should make its offer for that JDA project to the landowner, because this cost will be major, and the business decision will be dependent on this cost as well, if some competitive offering is made by the developer to the landowner in such kind of commercial projects. Now the case 6, here the new scheme, residential projects and revenue sharing arrangement. So the JDA date is in the second phase. Construction period is also in second phase. Here the revenue sharing arrangement is there. So no reciprocal supply, only one-way supply. So here the landowner is supplying development rights in favor of developer. But in turn, developer is not providing any construction service to the landowner. He is only sharing 30% of the sales revenue with the landowner. So if the project is construction of the project lifespan is 8 years, and the last unit the developer sells in the 8th year with the appreciated price, then for that appreciated price also the developer landowner is getting 30% share. So that kind of arrangement. Here, since development rights are supplied by the landowner in favor of developer, who is a promoter, the GST is applicable under reverse charge basis. So he should pay under reverse charge. But since this is a residential project, there is a conditional exemption applicable. So here in this case, conditional exemption applicable, that if the landowner sells all the units before completion, then no need to pay under reverse charge. But as on the date of completion, if some units remain unsold, then on that value, he need to pay under reverse charge. And for the value of that development rights here, the value will be 30% share in the sales revenue shared with the developer, shared with the landowner, plus value of premium FSI, TDR, etc., etc. So many times the 30% share in the sales revenue is not clear even on the date of completion as well, because if as on the date of completion, if entire amount is not entire units are not sold, then those units will be sold in the coming years with the appreciated price. So it is suggested as on the date of completion, at least at the on the value of the reckoner value of those unsold units, you should make this payment under reverse charge. And if any additional consideration is flowing to the landowner after that, then in the latter period, the developer should pay under reverse charge on that additional consideration to the landowner towards development rights. That is the way this provision can be complied with, in my view. Then the time of supply of development rights, any time before or on the date of issuance of occupancy or completion certificate. So here actually this will not come 1 or 5%, because in this scenario he is not providing any construction of complex service. So this is just a typographic. I just forgot to delete that. So here only one way supply is there. His landowner is supplying development rights. In turn, developer is not supplying any construction service. In the case 7 for commercial projects, revenue sharing. Here, similar to earlier case, JDA date is second phase of GST implementation for real estate sector, and then the construction is also in second phase. So 120 commercial apartments, 30% revenue share is shared with the landowner. And so yes, he need to pay under reverse charge, and no exemption is available. He should pay under reverse charge and take the credit of it. So in this scenario, the rate of development, the value of development right will be 30% of sales revenue shared with the landowner, plus other payment towards value of premium site, TDI, etc. And time of supply for development right will be date of payment made by the promoter for transfer of rights or FSI of service, or within 60 days from the contract, whichever is earlier. So he has to make the payment and he has to take the credit of it. So this is typically the time of supply for that, this kind of arrangement, and he will be able to take the input tax credit of it. So friends, these are the cases I have covered related to JDA arrangement. I have also included in my project presentation some other practical examples. I will be sharing this PPT with the Pune branch. You can download it from their website for your reference. I have also included certain provisions applicable in the first phase and second phase. What is the difference, shared treatment with respect to different provisions in the first phase and second phase. I will be sharing these provisions. As we have came to the end of our session, I will just touch upon the provisions related to sale of developed plots, and then we will take the question answers. With respect to sale of developed plots, the background is when that contradictory advance ruling came from the Gujarat Advance Ruling Authority, and later on from Madhya Pradesh Advance Ruling Authority as well. And in that advance ruling, they have given that sale of developed plot is subject to GST, and they equated it with the construction of complex service, and they have given the ruling that GST should be charged on that. And after that advance ruling, many notices were issued by the department to many SSCs, many developers for those sale of developed plots for payment of GST on that. Some of them have made payment as well. Many professionals have taken view at that time and they have defended their clients that this is not subject to GST because this is nothing but the sale of land, but sale of developed land. You can at the most charge the GST on the development services, but not on entire amount charged for the sale of developed plots. So we were also suggesting at that time that you should make two separate portion. One is for sale of land and another for sale of providing development services and charge GST on development services like that. Later on, to give some clarification, a department has given clarification and they have issued this circular, and they have clarified that GST will not be applicable on that. As per Schedule 3, GST is not applicable on sale of land, and land may be sold either as it is or after some development such as leveling, laying down drainage lines, water lines, electricity lines, etc. And they have clarified the sale of such developed land is also sale of land, and it is covered by serial number 5 of Schedule 3 and accordingly does not attract GST. Since department has clarified this, now no GST is applicable on sale of developed plots. But although they have mentioned this, etc. word is very, I would say, critical. We need to suggest our clients that they should see where to stop for this etc. words, because many times some developers, they provide some clubhouse services, some swimming pool, etc. They go beyond these basic amenities and they provide some extra premium amenities in that developed plot project. In that scenario, department still may take a different view that this is nothing, this is the development service which you are going beyond the basic requirements of the RERA project and you are providing additional services, so you should charge GST on that development services. So typically we should suggest our clients, if they are providing basic amenities like drainage line, water line, electricity, roads, etc., then no need to charge GST. But if they are providing some additional amenities, then it is better that they should charge GST on that, so that in later years litigation will not be there. Also, although they have clarified that it will be subject to, it will be treated as sale of land and no GST on that, still many clarifications are pending. That clarifications with respect to JDA arrangement, with respect to developed plotted layout, because advanced rulings in case of marsh spaces by Karnataka Advanced Ruling Authority and Madhya Pradesh in case of Vidit builders, etc. They have given some confusing advanced ruling and different views are possible in that area. As per these advanced ruling, although the units are sold to the ultimate buyer and the developer is charging to the ultimate buyer only, still these advanced rulings state that there is an element of joint development and the developer is providing development rights, development service or the construction service to the developer, landowner, and landowner is transferring development rights. Accordingly, the treatment must be given, and he must also charge the landowner as well, along with the ultimate buyer. So, in this area, some clarification is required from the department side so that there will be clarity. Then what will be the case where because of department has issued the notices and some taxpayers or the developers, they have paid GST on the sale of developed plots. So in my view, they can claim the refund and they can get the refund under section 54. So that can be claimed within the required limitation period of 2 years. So that can be claimed if someone has made the payment, and the issues can be, as I stated, each and every arrangement we must go through what actual amenities the developer is providing. If those are basic amenities, then that is fine. But if they are providing some additional facilities, some premium facilities, then different view can be taken. A GST can be charged for those additional development services. So friends, that is the status of sale of developed plots. So within the 2 hours time frame, I have tried to cover the GST provisions applicable to the real estate sector and provisions applicable to the JD arrangements as well. So with this, I end my presentation here, and we can take some question answers. Hello, Pranav.
Hello. Thank you so much for the excellent session. We have actually 3-4 questions in the chat box. So I'll just read out for the facts of the case are like the JD states 1 CR non-refundable deposit on signing the joint development agreement plus 5 flats for landowner and balance 5 flats for builder. The landowner keeps three and sells the balance before completion certificate is obtained, and builder has sold all the flats before the completion certificate. Now there are 2 questions. One is the 3 flats retained by the landowner considered as unsold for computing RCM on development rights? And question 2, you mentioned that landowner has to take GST and can also take input when he plans to sell the flat. Many landowners do not do this, and the builder merely pays the GST on behalf of the landowner. Is it right? So these are 2 questions.
Okay. In this arrangement, he's allowing the first question is the 3 flats retained by the landowner considered as unsold for computing RCM on development rights? No, the flats allotted to the landowners will be considered as sold units, because those are sold as good as sold to the landowner for the consideration in terms of development rights. So for that calculation, it will be treated as sold units. Only his share of apartments, the builder's share, in this case, balance 5 flats are available for him. Okay, so 5 flats, if there are unsold out of these 5 flats, only those will be considered. Then yes, this is the case. Many times the landowner, even if he sells some units of his shares before completion, he does not take registration, but the builder only sells his share. If that is the case, what is happening here? They are changing the consideration. Earlier, let's say the arrangement in this case is they are providing landowner 3 units, 3 flats, correct? And out of these 3 flats, if 1 flat is sold under construction, and if builder sells it for landowner and he pass on the consideration to the landowner, then he's changing the consideration. Instead of 3 flats, he will now allot the landowner only 2 flats, and for 1 flat he will pay him in monetary terms. So some change, supplementary deed must be executed for this change of consideration, and all other treatment will be similar, but that supplementary deed must be executed. Supplementary, some agreement must be executed that there is change of consideration, and now instead of 3 flats, landowner is only taking 3 flats, and amount of 1 flat is taking from builder. So then developer is complying with the means he is selling on his behalf in that scenario. So that will be the answer.
Right. Thank you. Then another question from Krishna Shinde. What is the meaning of first occupation? Then can we again explain in brief about the reversal of ITC post 2019? What are the documents that needs to be issued if promoter is paying GST on advance received? And what is RREP?
Okay. The first question is, what is the meaning of
first occupation?
So as clarified by department, first means first occupation is official occupancy certificate. So for the project, if you are getting occupancy certificate, in Marathi we can call it as Bhogavta Patra. So if you are getting that occupancy certificate from the municipal corporation or the PMRDA, that will be regarded as the first occupation. Then can we again explain the reversal of ITC post 2019? So after 1st April 2019, they have amended the reversal provisions with respect to ITC for builders and developers. Now, after 1/4/2019, it is applicable only for the commercial projects. because for the residential project, since ITC is not claimed at all, so no need of reversal. For commercial projects, as on the date of completion, some unsold units are there, then to that extent, ITC must be reversed. So what is the difference now? Now, from the start of the project till the end of the project, if the span is 4 years, 3 years, 5 years, for that entire period, entire ITC will be treated as common ITC. And reversal will be required at the end of the project. And it will be on the basis of area. So on the date of completion for that commercial project, if 40% units are unsold, then you will calculate the entire ITC for that project. Let's say it's 1 crore rupees. Then 40% is an unsold area, carpet area. Then 40% ITC will be disallowed. And you need to reverse that 40%, 40 lakh worth of ITC. So that will be the case. Then what are the documents needed? Issued for the paying GST in advance. So just the advance receipt you will issue and you will charge GST in that. So that you will issue, you will charge GST at the rate of 1 or 5% and you will pay on that. Here I would like to mention here, since the builder is providing construction of complex service, which is a works contract service, a species of works contract service, which is in the GST's terminology, it's a continuous supply of service because it is the span is more than 3 months. So it's a continuous supply of service. So for continuous supply of service, milestone theory applies. So the developer is free to define its milestone in his agreement of sale. So he can define his milestones. He can define that you should pay at the end of the project. That can also be the clause. Clause can be at the time of plinth, you will pay this much, then first slab this much, second slab this much, or as per the percentage completion you will pay, whatever. All the clause can be you will pay upfront. Whatever you want to define, you can define. That liberty is with the developer. But once the developer defines that milestone in the development agreement, that sale agreement with the buyer, then he should stick to it. Then the GST payment will be as per that milestones. So either receipt of payment or achievement of milestone, whichever is earlier, the GST liability will arise. That the developer must keep in mind. And on the completion date, since the provision of service is complete, you need to pay GST on all entire sold units. You cannot say that since the amount is pending, amount is not yet received, 40% amount is not yet received. Still, you need to pay GST on entire sold units because completion has arrived. That is the case. Now, the fourth question is, what is RREP? So RREP is a project in which the commercial portion is not more than 15%. So that is a mixed project where commercial portion is not more than 15%. For that kind of project, for commercial units, rate will be 5%. For residential units, the rate will be 1 or 5%.
Right. Another question is, if the flat is sold before completion, then the landowner has to take separate registration for 30% of share of land, or the developer can discharge the liability of landowner.
As I stated, the original arrangement is there that landowner will get the 30% units. So if he's selling his share of units before completion, technically he must get himself registered because he is selling under construction units. He is also a promoter as per RERA. So he should get himself registered and he should charge GST. And whatever GST charged by the developers to him, he is eligible for the ITC of it. So this is what is expected. In many cases, we see that the landowner is not getting himself registered, but the landowner is only selling his share as well. In that case, for landowner, for income tax purpose, the sale is different. For GST purpose, sale amount is different. For income tax, let's say 100 units are there. 40 units are landowners units, 60 units are developers units. If he sell all the units before completion, for income tax, he is showing only the sales consideration of 60 units. But for GST purpose, he is complying for all 100 units. So that is the basic difference. Then he has to give repo and all that. But if this is the case, then you need to execute another supplementary deed that you are changing the consideration. Now they are changing the consideration. Now the consideration is that instead of units, now the landowner is selling the units himself and he's providing him monetary consideration like that. So you need to enter into that kind of change in consideration supplementary deed. But as per the original arrangement, he must get himself registered and he should comply with that, the GST provisions.
Right. I think the similar question is that in the example number 7, 30% of sales revenue to landlord. If units are sold after the completion of project, then what about 30% of the share to landlord and RCM on it for units which are sold after completion of the same?
Yes, the 30% of the revenue to the landowner.
To the landowner.
Okay, and it is a residential project. Okay, so it's a residential project. So there is a payment of reverse charge and there is exemption, conditional exemption. Okay. So in this case, if the developer's share is 100% units.
No, the clarification has come that it is a commercial project.
Okay, it's a commercial project. So if it is a commercial project, then there is no exemption, first of all. There is reverse charge, but there is no exemption. Correct. So the 30% portion, whatever the sales revenue of that project, he should pay under reverse charge and he should take the input tax credit of it. So in this case, he should derive that 30% sales revenue first. So here the difficulty first is how to determine that value, because unless and until he says the last unit, you will not be in position to determine 30% of sale revenue. That is a difficulty. So the suggested here is, based on the reckoner value, you should determine this amount, what is the 30% value of the sales revenue. And on that value, 30% you will, on the 30% value, you will charge at the rate of 18% and you should make the payment under reverse charge. And you should take the input tax credit of it. That is the compliance you have to make here. And whatever sale you are doing, that will be at the rate of 12% and you will take the ITC of it. So that will be the scenario in this case. As on the date of completion, there will be reversal and not on the payment of RCM basis. There will be reversal of input tax credit because this is a commercial project with the 12% rate with the ITC is allowed. That is the answer.
Right. Another question, would GST be liable on lease premiums paid to MIDC? Will it make a difference if the leasehold rights are purchased from MIDC and from third persons?
Yes. So here, in this case, typically, if you are paying the lease amount to the MIDC, then the treatment is different. But many times, what happens, the MIDC is allotted a plot to a first lessee. Later on, you approach to that first lessee and ask him, approach that lessee for that plot. In that scenario, he assigns those leasehold rights in your favor and takes some consideration for assignment of leasehold rights. So assignment of leasehold rights is not lease premium. There is a different service. It's an assignment of leasehold rights service. That is agreeing to do something, tolerating an act of getting itself out of that arrangement. So it's agreeing to do something service. So for that, it is a residual rate will be applicable at the rate of 18% and GST will be applicable on that consideration, compensation payable to that person, that first lessee, to move out so that you can make the lease agreement with the MIDC. So that third person is getting compensation. So GST will be applicable on that. So that is the scenario. For lease premium which you are paying to the what I would say, this MIDC. In that scenario, if that is for more than 30 years, that is under reverse charge. Then if it is for residential project or something like that, then there is a conditional exemption and all that. If it is allotted by government to the MIDC, then there is exemption. But if it is allotted to the industrial unit, then first, and there is a lease premium, then in some cases there is a specific exemption, then only it is exempted. If that does not apply, then there is no exemption. That is the case. But if assignment of leasehold right is there, then this is not lease premium, and lease GST will be applicable on that assignment of leasehold right.
Yes. Another question is, if credit note is created next year, then whether ITC can be adjusted?
If you create the credit note next year up to the October month, that is now the timeline is the 30th November. If the periodicity of filing return is monthly, then before 30th November, you will file the October month's return. If it is within that time frame, then it can be adjusted. If it falls beyond that, then you would not be able to adjust it.
Right. Another question is, if on sale of developed land, development is not completed, then whether it is incomplete project and liable to GST on entire amount.
As I stated, now department has clarified, sale of developed plot, if you are providing basic amenities, then it is not subject to GST. They have clarified it after the GST council meeting, and they have also issued the circular. But if you are providing some additional extra development services like clubhouse or swimming pool or any extra like that, then if you are executing that agreement in the under construction phase, then for those development services, you should charge GST on that development charges. You should make separate billing for development charges and charge GST on that. If after completion of those development service facilities, those extra facilities, no need to charge GST.
Right. And another question: if we have received part completion on a commercial building that is up to second floor, but the building is of 10 floors and registered in RERA as a single building, so should we do reversal working and reverse the ITC for part completion of the building?
So here for the RERA, it's a single building. So 10 floor building is a single project for RERA purpose. Correct. So, and for that RERA project, you have got the part completion. Correct. So
right.
In this scenario, what is his query?
His query is that only to the commercial project, the part completion is received up to second floor only, though it's a 10-story building. So should we do the reversal working and reverse the ITC for part completion of the building?
In my
probably
view, yes.
Till second floor.
In my view, yes. Since for that part completion up to second floor, you have got the completion, and you will be selling those units after completion, part completion, and you will not be charging any GST on that. It will be exempt supply. So reversal working will be required for that.
Right. One more question is, if dealer construct commercial building such as shops, hospitals, etc., and gives those units on rent, whether he will get set off of ITC on construction material against the GST liability on rent.
As I stated earlier in the initial, at the start of my presentation, there is a High Court judgment, Odisha High Court judgment in case of safari retreats. There, for that mall building, the High Court allowed the ITC of that. But department has gone into Supreme Court. For that matter, they have filed SLP. So now it is pending before Supreme Court. So department is not allowing it, and it will be a litigative case. So it is not suggested, because taking into consideration the approach of department or the government towards implementation of GST, many times they amend the provisions retrospectively. They insert the clauses like that. So intention of department is not to allow the credit of this kind of, they only allow the credit of works contract service or construction service only to the works contractor. If you are giving it on rent, etc., then this credit is not allowed. So taking this into consideration, in my view, it should not be it should not be taken.
So there is one query on redevelopment. In an apartment, all the apartment holders are going for redevelopment. No outside sale will be made, and the entire reconstructed area will be occupied by the same apartment holders. Will the apartment be required to get registered under GST and pay either 1 or 5% of GST? If yes, on what value?
Here, all the apartment holders are going to redevelop. They are on their own.
On their own, yes.
So it's a case of self-redevelopment.
Self-redevelopment. And there will be no additional sale to the outside parties.
Okay, no issue. So whom you will charge? You will not charge to anyone. But only thing is, whether this is society or what. If it is a society redevelopment, in whose name land is that there? If it is in society's name, then we have discussed that case, that there is no concept of mutuality in GST. Even if the society is redeveloping and allotting units to the its individual members, then it get itself registered and charge GST on that. That is my personal view. Although different view is possible, but if there is society, if there are 5 joint owners, 5 joint or 5, 4, 5, 10 joint owners, and on their own they are redeveloping it. There is no society, and everyone is sharing their cost, and they are just constructing on their own. Then no need of charging GST. But if there is a society, there are members, and they are going by way of that self-redevelopment route, then as I stated earlier, department may ask you for that GST, because in department's eyes, society and its members are different. That is the reason they are also charging GST on the maintenance services, although there is a specific exemption up to 7,500. So that is the.
Yashwant, I just want to add one thing.
Yes.
Many questions are having with the limited fact on record. So just in case, in this case also, we have very limited facts on record.
Yes.
For the fact we can consider differently. Means if the society is constructing, if the developer is constructing, who is constructing, all factual position will change the opinion.
Agree with you, Rajesh. Rajesh, this is true. Although as per the wording of agreement, the treatment will change. What are the facts? Who is developing? Like in this case, you are saying that on their own they are developing. But on their own means on their own account, or the society is redeveloping. So based on that, the answer will change.
Right. Okay. One more question. One of the developer transfers his development right to another developer, and second developer took registration under RERA. How the taxation will be for the second developer project? Is it a mixed project? Rather, it's a mixed project, commercial as well as residential. So they wanted to know whether how the taxation will be there for the second developer.
Here the treatment, in my view, will be same. Here he's assigning his development rights, or he's just passing on his development arrangement to some other builder. He's transferring, assigning that development rights in another favor. Correct.
Right.
So in this case, if the first developer is getting something for transferring this arrangement to another developer, whatever he is getting, I would not say it is a consideration for development rights, because he just getting some consideration for tolerating an act, just transferring that, because he is not the landowner. The first developer is not the landowner. The landowner is different. He's just the first developer. He's transferring this arrangement to the another developer. So the first developer, if he is getting some consideration in this arrangement, that will be just the compensation or the consideration for agreeing to this kind of arrangement, for backing out from that development arrangement and letting the second developer entering in that arrangement. So the consideration paid to him will not be the part of development rights, consideration for development rights. Apart from that, all other consideration, whatever in the form of construction service provided to the landowner, in the other monetary consideration to the landowner, will form part of development rights. And other treatment will be as discussed during our presentation. Other treatment will be similar.
Right. One more question is, so if a builder of a residential flat gives part construction as a subcontract to another builder, then the subcontractor will charge 18% to the builder, and he will not be eligible to get any ITC.
If a builder of a residential flats gives part construction
to a subcontractor as a subcontract another builder, then the question is whether the subcontractor will charge 18% to the builder, and whether he will or he will not get the ITC.
He will charge 18%, of course, if he is acting as a contractor for another builder. So he will be in the shoes of first contractor for another builder. And if another builder is developing residential project, then ITC is not allowed. If he is constructing commercial project, then ITC is allowed.
Again, some facts are missing.
Yes, again, all facts are not there. So if all facts are there, the answer may change.
He will not be eligible for ITC, matlab builder will not be or the subcontractor.
Subcontractor is of course eligible for ITC, builder will not be eligible.
That is the
are not clear here.
Right. So we'll take up a last question, which is read as, what is the rate that a contractor should charge on works contract service if builder is building residential apartment under PM Awas Yojana? And what is the rate that the contractor should charge for works contract services of a building for building an education building?
Here, in this case, the contractor, if he is providing service for the affordable residential apartments, then there is a concessional rate of 12%. But if you go through the updated notification, 11/2017, updated as of now, you will not find any entries related to any affordable project like PM Awas Yojana, etc., PMAY, etc. For ongoing project as on 1/4/2019, only for ongoing projects which were ongoing as on that date, those projects will be affordable housing projects as of now. So for those projects, that rate will apply. For new projects, for affordable units, now we have two thresholds. One is area threshold, another is monetary threshold. 60 square meter, 90 square meter area threshold and monetary threshold. If the units are qualifying that criteria, and if at least 50% units in that projects are affordable units, then the concessional rate of 12% applies. Otherwise, 18%. That is the status as of now.
So actually, there are two more questions. So with your permission, can we take those?
Yes.
Yes. So one question is whether the RCM on TDR is applicable on commercial units in RREP, or is it covered under conditional exemption? This is question number one. And second is, if RCM is applicable, then at what point the RCM is to be paid and on what value?
Here, in this scenario, this is a very good question actually. Here, two views are there actually. In this case, you have to comply with either of the view. I would say you can say that this is RREP. So this is residential real estate project as they define RREP. So they are defining residential real estate project. So they are themselves saying this is a residential project. This is one view. So in this case, the conditional exemption is available is one view. Another view is, since they have only given concession for the rate, there is no specific mention of exemption about RREP in that notification. And since for the portion of commercial units, although rate is concessional, the reverse charge is applicable, but exemption is not there. This is another view. So you can go by its name and say it's a residential project, so conditional exemption is there, and go for that. So I would say we can leave it to the developer. We can make him aware both the stands. If he thinks and he wants to take the risk, that much scope is there, and you can go for that view. And if you say that it's a residential project, then of course RCM will be applicable, and it will be applicable. Value will be similarly calculated as we have discussed in the presentation, and the date will be also same as on the date of completion or before that. So that will be applicable case.
Right. And the last question being, how to calculate value of TDR in case of SRA project as TDR are not sold?
As the
TDR are not sold. I think
I'm not clear about this. Actually, you have to mention some facts.
actually
Because if for that SRA projects you are getting some TDR, if additional TDR from the department authority for constructing that TDR, then if you have not paid for that, then you are constructing that construction cost is consideration for the TDR.
right. So
it will depend on the facts, what TDR you are talking about.
So the additional facts which are provided are in case SRA project will there be any GST payable on TDR received, and what will be the time if GST payable by the developer?
If that is SRA project, typically SRA projects are residential projects. So on TDR, GST is payable, of course, even if you are paying consideration in the form of construction service, that is payable under reverse charge. And when payable, as on the date of completion, if some unsold units are there. Because for SRA projects also, since it is residential project, there is reverse charge applicable for TDR, GST payment, and there is conditional exemption as well. All other provisions related to reverse charge, conditional exemptions are still there since it's a residential project.
Right. And one question actually we missed out. It's quoted as what is the rate that the contractor should charge for works contract services of building a educational building?
So I have covered this actually. Unless and until there is any specific exemption notification available, the rate is there. You should charge 18%. So there is no conditional exemption available.
Okay.
So here some midday meal scheme entry was there. I need to check whether it is still there. If there is midday meal scheme, which is if the building for that purpose is constructed, then the concessional rate of 12% was applicable. But apart from that, if some charitable educational institute is there, and if you are constructing hostel for that institute, school building, college building, there is no concessional available. Rate is still 18%.
Yes. Thank you so much, sir, for the wonderful and insightful session. As we can see from the chat box, the response is like it's a very practical and very insightful and helpful session. Amazing session, which is being quoted by all the members. So we are very much thankful to you for giving such excellent session and benefiting all of us.
Thank you.
Thank you.
Once again, thank Pune branch of WRC for giving me chance to interact with all of you. Thank you.
Thank you from Pune branch, sir. As we are beginning with session, this session is divided into 3 parts. Project before in the service tax era, after service tax era, but before 31st March 19 era, but project after 1st April 19 with existing scheme, with new scheme. The topic is so vast. In each case, the opinion will change. That's why there are so many questions even after the vast elaboration, because each line of contract will differentiate the opinion.
Agree with you.
So, sir, on behalf of Pune branch, all the participants, really thankful to you for coming, joining this session and giving your insights on the topic. Thank you, sir. Thanks a lot. Thanks to all participants for patient listening. I request Pranav to formally give vote of thanks.
Yes, before we proceed to the formal vote of thanks, with the permission of CA Yashwant sir, we would like to tell that we'll be uploading the presentation on the Pune website. So many members are asking for it. So with the permission of Yashwant sir, we'll be uploading on the Pune website.
Yes, certainly.
And thank you, Yashwant sir, for sparing the time in spite of the busy schedule and giving us the insightful session on the GST with covering of various aspects like Rajesh sir said about pre, post, and all kinds of combinations. And thank you so much, sir.
Thank you, Pranav. Thank you all. Thank you, Rajesh.
Thank you.
Yes, thank you so much.